So I was talking about the UK, where there's 1 million people now applied for welfare. So some of these numbers coming out are pretty staggering. And employers cut 701,000 jobs last month at the start of the collapse. That's more jobs, which will show in a chart, that's been created over the last 10 years. So if we go to, which I've talked about in the past, is the participation rate here, which measures everybody over the age of 16 years old in the civilian workforce. So unemployment numbers, like I say, are kind of always talked about because they look better, because they don't count people that aren't looking for work or giving up on looking for work. So the participation rate, which I've mentioned in other videos, actually peaked out here before the last crash up around 67, then came all the way down to 63. Of course, some of that is the boomers retiring, but a lot of that is people that just never got back into the workforce, and a lot of those people just simply went on long-term disability. People in their 50s, 55, nobody wants to hire you really at that age, and so they just ended up on kind of a long-term disability, never re-entered the workforce. And what we've seen now, and this of course isn't the latest data, I just downloaded this the other day, but there's a lag on. I'm not sure if this comes out weekly or monthly, but you can see a sharp drop at the end, and that's pretty much wiped out what little gains we really did get in the participation rate. So I've got 63 there, and yeah, we're down to 62 or so. So just over a period of a month, we've seen 10 years worth of job gains just disappear, which is just totally unprecedented. And again, I just think there's going to be a lot more fallout yet. So like I said, the longer this goes on, the slower the recovery, and a lot of businesses will go bankrupt, so they will not reopen. And the ones that do are going to have to deal with things like accounts payable. They're going to have to deal with loan interest that's payable. The last thing they really want to do is hire new people, right? They just want to try to save their business from insolvency. And that's what I think is going to push this out and make it more of a U-shape or L-shape type of recovery. And then on top of that, the workers that do get employed, they're going to have to deal with their own financial situation too, so they won't be going out and consuming as much. And we know the US economy, 70% of GDP is by kind of retail type spending, right? Because they import so much goods. So again, a few more. And then on top of that, we've got the accumulation of debt by the governments, because they're going to have to provide all these wages. The Fed's going to have to buy up corporate debt to stop companies going completely bankrupt, just like they did in 2009 when the housing market collapsed. All these mortgages were sitting on the bank's asset side of their statements that were maybe really only worth 50, 60 cents on the dollar, because the odds of the mortgage being paid back was at about that, maybe 50 or 60%. But the Fed just came in, printed money, bought those mortgage-backed securities, which is just a bundle of mortgages, and basically gave the banks cash for that. So the reckless behavior of the banks lending out all these mortgages, they really didn't receive any punishment for that. And then because they did that, the same attitude on Wall Street has persisted for the last 10 years. From that, as I mentioned in previous videos, the money printed goes to the banks and goes to a hedge fund. The hedge fund then tells a company to do share buybacks, and which I've got a whole video on that you can look at. So, but this is just now kind of an extension of what happened in 2009. So I think the recovery is going to be longer, and the downside will probably be worse. And we're seeing that, so the coronavirus was really kind of I think the coronavirus itself would have been bad, but it's being made worse because all the debt, total debt in the world now I think is 270% to GDP. I think Canada, for example, the United States now I think is about 100%, 110% debt to GDP. But years ago, 20, 30 years ago, we probably had a lot of, even Canada was probably just 20 or 30% debt to GDP. So we just see debt continuing to explode. And I'll show that here, which I've done before. So we can show the M1 money supply. So the M1, there's like an M1, M2, I'm sure there's an M3, but there's the M1 is cash or near cash. So something that can be converted into cash very quickly. So we could say demand deposits, checking accounts, that type of thing. And we can see here, since this is not a logarithmic scale, so it's a little bit misleading, but we can see in 2009 this gray area, we're almost at a 45-degree angle with the money being printed, and you won't see this at the end, but it's spiked right up, almost, $400 billion in a matter of a month. So, and then the M2 is kind of the same thing. And we've had this huge spike at the end. So the M2 includes checking accounts and money market funds and all deposits. So it's just a broader measure of cash type assets. But with all this money printing, we don't know if how it's going to happen. Is it eventually going to debase the American currency? There's arguments over that it might not, because everybody else is doing the same thing. So Europe's doing the same thing, Japan's doing the same thing. I'm not sure what's happening in China. And so the US dollar index has actually been quite strong, but we've got to start looking at other asset classes. We do see gold start to move up, which is a hedge against inflation. And I personally have started to mention in a previous video, I opened up my Coinbase account and I've started to buy a little bit of Bitcoin, Ethereum, and I might look at some other of the cryptocurrencies. But I just don't have the time to spend analyzing that whole market. But Bitcoin now does have like a capitalization of about 150 billion. I don't think it's going away, and it's just something totally outside of the fiat money system. So I think it's probably, and who knows what's going to happen to that in the long term, but I just figure it's good to have some diversification. So and then we go to about that delay, but we go to the Fed balance sheet, which does seem to get updated, I think, weekly, because I noticed this has just spiked. You won't see it here, but the first quantitative easing that they did back in around 2008 was roughly $1 trillion. So they took their balance sheet from 800 up to 1.2 trillion, and then they basically tried to undo that. Never had any success, and we got up here to about 4.5 trillion. Again, they tried to normalize that. I talked about in December or October 2017, market came down, had to print money again. But we've just had like a spike straight up here. We're at almost looking like about 5.7 trillion. So they've added 1.5 trillion in quite literally a month of just money. They've not as simple as that, but basically printed. And now they've said they're gonna start buying corporate bonds and all that type of stuff. Plus they're gonna have to buy the treasuries to off the government for their fiscal policies, you know, to send checks to people, all that. The government doesn't have really any assets, it's got a deficit, so it's gonna have to float treasuries for that. So we can see these balance sheets maybe going up to $8-9 trillion, and nobody really knows what's that going to do. Are they just going to be able to monetize the debt, leave it